Oh, we're ready. Oh boy. Oh boy. You are not prepared for what's to come. I'm not prepared for what's to come, I gotta tell you. I'm just, everyone right now, we honestly gotta be ready to get our feelings hurt. All right. All right. Come on, somebody. Come on, somebody. Powell, listen to me. You know what to do. Powell, you know what to do. You know what? Not that. Not that, Powell. Not this. Not this, Powell. That's us. That's us, brother. Oh, baby. Who's ready to suffer? I got blood on the streets just in case. Just in case I got the blood on the streets. Want to be ready, fam. Oh, my gosh. Don't drop the soap. You're right. Welcome, welcome, welcome. So many people watching this. So many people are going to be paying attention because we also have Donald J. Trump speaking from the Oval Office at 12 p.m. So right after we watch this, not Pirates of the Caribbean, of course, but the Fed, right after we watch this, what he has to say, I still have to find the link. So if somebody has a link or just tag me on X, please, I'll find it. But it's gonna be so good, guys. I got my glasses on. We got Ghost in the house. We got Chipper. We got some members here too. Emily is there too. What's up? What's up? So today, Fed Chair Powell will speak 10 a.m. at the Jackson Hole Economic Symposium. So we go ahead and get this and post it right here. And give me a link, please. Give me a link. If somebody has the link, let me know because I'm trying to find. It's always like so difficult to find a link here. It's like crazy. I got you. I got you. Okay, so they're talking about, this symposium that is Bloomberg. What's up, Darius? Thank you so much for the first super chat of the house. Today.
They want us to sell, but the only thing I'm selling is my house to buy more XRP.
You're right, brother. You're right. You're right. You're right. 100%. Let me do this. Oh, I know. Is there like a... Okay, maybe Bloomberg Television. Maybe Bloomberg Television. That's going to be good. You could watch this one. That's Bloomberg, so they're going to have something official, right? I guess. Whatever it is, we'll find it. We'll find it. There's no link from them. Let me see. Everybody... Oh, here it is. Here it is. Here it is. Let's take a look. You have an Kansas City. Oh, there it is. Found something that's going to help us out. Jackson Hole Economics Policy Symposium opening remarks. Jerome Powell, chair. The Papa Powell, the one and only. The one you like. The one you love. John 360 on the house. What's up, buddy? Welcome. So, I hope he speaks like at least 20 minutes. Come on, man, because he doesn't really say much sometimes. So I hope you do something for us. Are you gonna give us a link or something for us to watch, or we just have to go crazy and find it? Drop a like, guys. Consider subscribing to the channel and turn on those notification bells, guys. Welcome back. Welcome, welcome, welcome aboard. Let's see. Oh man, here. Okay. So we're gonna have us. This is today, 8 a.m. Friday. Opening remarks, 8 a.m. So it's supposed to be in like about 20 minutes. So, okay, 30 minutes maybe. Okay, where's the link, my friend? Are you guys gonna do this live, right? I'm sure.
So ETFs can buy at a good price.
Nice, Richard. What's up, buddy? Welcome. So happy to have you here. Come on, man. Give me something. Give me something. Okay, I don't see a link where we can actually watch it, but we found the agenda. You can see right there that it's them. So my second plan is kind of take a look at Bloomberg, maybe Bloomberg Television.
The long-term mean of the exchange rate between the US dollar and the euro.
So I'm gonna have this one on just in case they have it right there.
Okay, if there's one AI,
it's the only place that I trust that I know it's gonna give us some good news right there.
Compared to the IBSI loop.
Oh yeah, you also have incredible language.
Is this like even close to The Hills Are Alive with the Sound of Music?
I did a lot of hiking here. The Tetons are outstanding. It's so nice to be here. And now I have to go back to the conference. It is a little bit something you are to see the nice scenery, but listening to a great speech that I expect from Governor Powell. But you can be very proud to have this Teton Mountains here in the United States.
Commensurate diplomat to just avoid talking about the Alps and how gorgeous they are, but definitely
but
someone.
You have to come to Bavaria.
All right, fam. Links down below, guys. Get comfy. We're gonna be listening to Jerome Powell for a while here on Bloomberg. It should be fun in about 20 minutes or so or less. What am I expecting per se? Like, what's going on here? Well, given the fact of all the news and updates that we've seen and that we've heard over the last couple of weeks, it's not difficult to get a cut. It's not difficult to get not impossible, right? But it makes it more difficult with the latest numbers that we've received.
Yields just slightly lower on the 10-year.
Good stuff. Philadelphia Fed president, I think, coming up live to speak with them. That's not bad. Jackson Hole, Wyoming. So cool, man. That's so cool. Yeah, I think the whole world right now here in the U.S., of course, we're expecting and waiting for this. That's Asian index update. So prices are steady, stable, and I think everybody's super ready for what's to come. I posted earlier right now. Today will be spicy by the dips. So we'll have our nice, set of a bunch of things that we are looking into. Price of crypto right now. Let's go ahead and take a look at. We're seeing a price of XRP at 285. Ooh, actually coming back up from the 278. That's not bad. Let's go ahead and open CoinMarketCap here in just a second. Very good. 283. In the 1 hour, we're seeing some nice green, which is not bad at all. BTC went down. I saw it, earlier today. BTC did go to $111,000, approaching. You see a nice double bottom right here at 1,811. That was at the beginning of August, and now about 20 days later, we have another $111,000, $112,000, and it just comes to show that even Bitcoin. Just look at this, everybody. I want to make sure that you get this one. It took us about a week and a half to go all the way to 124,000, and a week and a half later, we are down back at that level. It comes to show that selling is a big part of making money. For those who are trading, for those who are doing more active investing, you are making money, right? But it's also known that not everybody knows when to sell. So people could have bought here and you sold here. It happens. So if you do that, if you buy here and you sell here, you're not making money. You are frustrated. You are mad. You are going to be angry, and you are going to blame so many people because you're not making money. You're losing money, right? So, how do we make money in crypto? Every chance you have to get a blood on the street day, you go in. And the more news and updates that, oh, dude, this is going to be terrible, you go in and you go in. And that's what I've been doing because I know a week and a half later, we can have a much better time in crypto. And there you go. You survived. And it's going to be up to you if you want to buy more or not. That's as simple as it gets. As simple as it gets. That's how you make money in crypto. All right. Let's get a poll right now, fam. Poll will be Powell will be dovish. What do you think? Everybody's like, dovish, Oscar? Are you kidding me? Or hawkish? Dovish or hawkish? Or neutral, maybe? What do you think? That's the poll, guys. For those who don't know, dovish is, more inclined to be bullish. Hawkish is bearish. You let me know. Come on, man. What's up, Jake? Tripper in the house. And nothing burger like always. I don't think this is going to be a nothing burger, to be honest with you. I don't think so. I think this is going to be a nice double with cheese, bacon, and extra pickles. This is going to be something that, plus we have Trump speaking after, right? I mean, it's going to be so good. All right. We have Bloomberg back, so get ready. We're going to be listening to Philadelphia Fed president, so it's going to be good.
The correction is we've forgotten what a bear market is, and we've forgotten what a 35% drawdown is.
We could sell.
Yes. Even Bitcoin, man, like tough. Meme coins are actually coming down. Pepe, Ponky, I see Brett too getting hammered right now.
But also who's going to save us is a former Philadelphia Fed President Patrick Harker, who joins us here on set after a sojourn in Yellowstone. You wonder why everyone knows now. Everybody knows that you are hiking in Yellowstone. We've been talking about this with everyone, that it feels very different this time around. How much behind closed doors do all of the Fed members talk about the importance of central bank independence? Is that something very much at the forefront of their minds?
It's essential. It's absolutely essential. We know history, right? We know when that gets lost, what happens. We know that in this country, and we know it in countries around the world. So it is absolutely critical, the independence of the Fed. That does not mean the Fed is not held accountable. I think this is important. Independence doesn't mean you get to do whatever you want to do. There is still an accountability. There's an accountability to Congress, and there's an accountability to the markets, right? There's an accountability to the American people more generally. So I think you can't lose sight of that.
There is an argument that ultimately, if there is a policy on the Fed, whether it's response to political pressure or not, to ease now, and then inflation picks back up, the markets will be the ultimate arbiter, right? That ultimately you will see some sort of market reaction that will be a natural check on whatever that is. Do you ascribe to that?
Yes, the bond markets. I mean, I look at the bond markets. Equities, they're choppy. They're always choppy. The fixed income folks, they're making longer term decisions. And so that's what I watch. And I think that.
Somebody just said right here, Jake, your poll shows no one knows what's going to happen. Guys, it's neck and neck. Dovish, hawkish, neutral. That really doesn't happen much. Wow, nobody knows.
It's the market that make monetary policy work.
So today, Jay Powell gets up with the markets anticipating a rate cut.
Yeah.
What does he say? Does he care what the markets are doing right now? Does he make the point that there's a lot of data? Does he open the door to a rate increase?
Yes.
Or cut?
No.
Yes.
No.
All those things. I think Jay will be cautious.
No hike.
I think he will try to, my own sense, move things more to neutral.
Penny.
That is,
Thank you, brother. Welcome.
Possibility of a September cut. I mean, if I think back low these 7 weeks ago when I left the Fed,
I see right there, brother. I see right there.
2 rate cuts in for this year. I think that's still appropriate. There's one other tool, though, that he's not going to signal, which I think is important to put on the table, which is the balance sheet. Right? We were talking about the rate cut, but the balance sheet runoff. My own view is I think we could the Fed should stop the runoff now. Right, and that's a signal that we want to sit here and see how things play out, and then maybe in September a cut or later. But I think the balance sheet, we often forget about it. Again, it's small now because we slowed the rate, but it's still there. And I think it's an important signal that we want to sit and wait. We are entering a period I'm worried about. It feels, it's not the 70s, but it does feel like stagflation light. Right? It doesn't feel great. When I talk to my contacts, there's something that just doesn't feel right.
Well, what's the balance of risks right now? Because we've heard a lot of your former colleagues say, we're worried about the labor market, but it still seems to be solid. We're worried about inflation, although it's only ticked up a little bit. We think it might in the future.
So I'm more worried about inflation in some ways because the labor market numbers are hard to discern right now. You think we're shrinking the labor force in some ways, right? And so we're keeping unemployment steady-ish. It's going to tick up, but steady-ish. So we're not going to see those big numbers of 100,000, 200,000 jobs. Part of it is because the labor market's shrinking.
We are mourning here at this Jackson Hole a wonderful guy, Charlie Plosser.
Yes, we are.
Just died. He was head of the Philadelphia Fed before you. I want you to recapitulate here right now, freshwater optimism about the American economic experiment that was with Finn Kinlan, Ned Prescott, and Charlie Plosser in Real Business Cycle Theory. Explain how that innovation isn't going to go away, even with the political intrusion of the moment.
No, I mean, Charlie was one of my mentors, and I just have tremendous respect for him. I was a director of the Fed when he was president, so I got to know him well. I knew him as a business school dean when I was a business school dean. He made tremendous contributions to education, to economics, and not just in macroeconomics, but economics more broadly. And so he's going to be really missed. And he was an incredibly strong and powerful voice for Fed independence.
Speak about centrist America, centrist Republicans, centrist Democrats that took, within the criticisms of RBC, said, you know what, this is about America and this is about our spirit. Is that at risk right now?
Yeah, so people would ask, what am I, a hawk or a dove? And I'd say I'm an eagle because I'm from Philadelphia. But now...
I don't get it.
Oh, God.
Ask people from Kansas City. They'll tell you all about it.
Ooh, sick burn.
But I consider myself right now a radical pragmatist, a radical centrist. We've got to get the center to rise up in the spirit of what Charlie and his colleagues did and reaffirm the centrality of markets, reaffirm the centrality of democracy. Those two go hand in hand. Human agency is what it's all about.
So we're about 7 minutes ahead of this speech, and one thing that you talked about a year ago when we were sitting here was something that stuck in my mind for the rest of the year, which is that at this point you are looking at anecdotes with almost more importance than the hard data, that gave you a more real-time view of things. How much is that even more so now, given some of the questions around, forget the politics of the moment, just the collection of data, the surveys that people aren't responding to, things of that nature?
Oh, yeah, just look at employment, right? You have the establishment survey, the household survey, those two aren't quite adding up. There's a lot of choppiness in that data right now. And so, you have to take that data seriously. And you have to be careful not to make anecdotes data, right? But you do need to listen to what people are saying. And people right now are sitting on their hands. What I'm hearing from lots of people is, I need to let some of this uncertainty. Now, the only exception to that are data centers, right? It's roaring ahead. The only problem is we don't have enough power to power these data centers. But there are areas of the economy that are growing, but a lot of people are just waiting.
Can I note here, Mike wants to get a question in. The temperature's dropped since we started live.
Oh, it feels warmer
than usual.
It's gone
43
I'm not complaining.
Do we expect snow today?
Oh, my God. It is actually warmer than usual.
Tom is not an outdoorsman.
Yeah.
42 degrees.
You can see Pat sitting there just in his sport coat.
Yeah,
He's
understatement
fine.
of the year. Carry on.
I want to ask you about the framework review, which is something that Mr. Powell is likely to talk about today. What's the most important change that they are likely to make?
If you read the framework review, it was written in a period where we thought interest rates were going to be zero or low forever, right? And inflation was going to be under 2%. And so there was that color to the previous review. That's all going to be taken out, obviously. And I hope I haven't seen the final, right? But I hope that they then emphasize more a balanced approach and more principles as opposed to tactics. Right? We don't need to get into the details of the tactics. That's what the committee does. They need to reassert the principles of the dual mandate.
Well, going forward, under whatever
dual
new
mandate
framework they have, do you think they can eliminate some of the risk that we saw coming into 2020 when Jay Powell here unveiled the last framework,
Your daddy's
which,
coming now.
less than a year later was being junked because of COVID?
Yeah, I get this question a lot. Like, before I went into every meeting, FOMC meeting, did I review the framework and that guided my decisions? The answer was no, right? You face the situation you have in front of you and you deal with the cards you're dealt with. And so the framework provides a broad sense of where the committee needs to go, but day to day, meeting by meeting, it does not drive the decision.
Wait, this is too important. This is
Julie,
breaking news.
100%.
Do you read the Fed minutes?
Yeah.
Wow, redhead.
I was in there, yeah.
Exactly, of course. He actually listens too. I am wondering, though, what the risk reward here is, and just to sort of crystallize the moment, what the harm would be of cutting by 25 or 50 basis points. And you talked about how you penciled that in. It wouldn't be that big of a deal. Are we just making these big, grand pronouncements about the same thing, that essentially it might make sense to cut on the margins, but not necessarily go wholesale to 1%? I mean, is that essentially what everyone seems to be coalescing around?
I don't see how you would go 1%, right? I mean, that's just simply not in the cards. 25 basis points, what matters is not the number, but the signal it sends, right? Because what the Fed is, because it's 25 basis points going to move the 10-year? No, not really. The market's going to move the 10-year. It's more the signal of where the Fed thinks the economy is, right, and where it's going. That's why I like the idea of pausing the balance sheet runoff as a signal. These are signals, not actual, they're not going to be reflected in people's mortgage rates or credit card rates.
Before we let you go, how much are people talking about who's going to come in to replace Fed Chair Jay Powell?
Well, all the time. You guys are talking about it all the time.
I thought you were among the Fed members.
Yeah, that I don't know. I mean, I haven't really, part of my deal when you leave the Fed is you have to sort of stay on the sidelines for a while. I mean, obviously people are concerned about that. It's a very important position for this country. And so, yeah, I'm cheering for the team that's making this selection, that they make the right choice.
Patrick Harker, thank you so much for being here.
Boom,
really appreciate
everybody.
it, and I guess go Eagles. Patrick Harker, former Philadelphia Fed president. We are awaiting that speech from Chair Powell, who is going to be speaking here in Jackson Hole in less than 3 minutes' time. Mike, we have been hearing from a number of people the fear of a 70s type of stagflation light. Not exactly 70s, but that seems to be the emphasis so far in the Fed speak we've heard so far.
Well, it's the data that we're seeing. We're seeing a slowdown in the labor market. We're seeing an increase in inflation, but I think the emphasis at this point would be on the light part of it.
So everybody, welcome back. Welcome. What do you think is going to happen as soon as he starts speaking and then we start hearing it? Because the markets are going to react. I'm talking about the stock market is open right now. It's Friday, it's open, and it's ready to bleed out if it needs to. And crypto market as well. It's so volatile. It's been holding the line, coming down a little bit in expectation of this market, of what's going to happen today. Plus, we got Donald J. Trump. After we hear Jerome Powell, we'll immediately go ahead and wait for Donald J. Trump at 12, I believe, Eastern, which is going to be 11 our time. So in about 2 hours or so, we'll see. That's a long time. But the point is that we're going to have a lot of things to cover today. It's going to be so exciting. Drop a like, guys. Let us know in the comments in the chat. Welcome. And we're heading to Powell's remarks now.
All the data that comes in, so it could be ex post or it could be just consensus.
Do the dots stay?
Look, the dots it's all the communication tool, and how do you communicate? Maybe get on Twitter. I will say that we are waiting for Jerome Powell to come out and give his speech. We're less than a minute away. Unclear exactly how he prepped for it. How do you think he prepped?
He had breakfast at the Pioneer
It's gonna be
You saw him?
I
good
said
afternoon.
Good morning to the chairman this
Good morning.
and I did not see if it was. I didn't see if he went healthy or full English.
Oh, yeah.
But-
I can
Oh,
guarantee
boy.
he
I
didn't
said
go
good
full
morning to the
English ahead of
chairman.
this, but this is going to be a monumental moment for him. His last speech speech at Jackson Hole as Fed chair with the whole world watching. Does he address independence? Does he deal with the inflation side of the mandate more than potentially the labor market side of things? And frankly, the international feel here, really notable, as you mentioned.
To me, that's a major theme for me, is the international community is screaming.
Yeah. Micah has some headlines.
The headlines are out. The chairman has started speaking, and here is the key phrase. The shifting balance of risks may warrant adjusting policy. That's going to get Wall Street's attention because it's opening the door to a rate cut.
Wait a second. You're telling me that he's...
The shifting balance of risks
Where's
may warrant
this?
adjusting our policy stance. The Fed is also announcing its new framework, which is pretty much as we were just talking about with Pat Harker, dropping the reference to the effective lower bound, eliminating the inflation makeup strategy, committing to contain inflation expectations and concern about labor market shortfalls. But the key here is that there are downside risks to employment, the Fed chairman says. The inflation outlook is that it will rise, but perhaps at a slower pace. So right now we are looking at a Fed that has the door open for a September 17th cut. And I guess, Lisa, we're probably going to see the long end and the short end reacting here.
Well, let's pull that up right now. You do see an absolute catering in yields on the heels of this opening up to the potential for rate cuts coming out. The downside risks to employment are rising. What you can see also rising, the S&P 500 now up 1.3%. Yields down 8 basis points on the long end for the 10-year, even more for the 2-year.
And looking at the inflation,
okay, so it's not
yield,
live.
The 10-year real yield comes in 6 basis points. That is substantial. It's still within the range, but at 1.86%, it's a real reversal towards a presumption of Fed accommodation.
Yeah, and this comes at a time where there is this question of how they are going to message this, given that inflation has remained above that 2% target since 2021. Mike, do we hear anything about why this is a Fed willing to look through that kind of inflation?
They do anticipate that tariffs are going to add to inflation, and they think it will take place over time, but they're still looking, at least as Chairman Powell puts it, they're still looking at these as one-time price adjustments within each sector. So it's likely that inflation is going to go up, but then they think it stabilizes and might go down again.
Well, right now, let's take a listen to Jay Powell, chair of the Federal Reserve.
Finally.
In my remarks today, I will first address the current economic situation and the near-term outlook for monetary policy. I will then turn to the results of our second public review of our monetary policy framework, as captured in the revised Statement on Longer-Run Goals and Monetary Policy Strategy that we released today. When I appeared at this podium 1 year ago, the economy was at an inflection point. Our policy rate had stood at 5.25% to 5.5% for more than a year. That restrictive policy stance was appropriate to help bring down inflation and to foster a sustainable balance between aggregate demand and supply. Inflation had moved much closer to our objective, and the labor market had cooled from its formerly overheated state. Upside risks to inflation had diminished, but the unemployment rate had increased by almost a full percentage point, a development that historically has not occurred outside of recessions. Over the subsequent 3 Federal Open Market Committee meetings, we recalibrated our policy stance, setting the stage for the labor market to remain in balance near maximum employment over the past year. This year, the economy has faced new challenges. Significantly higher tariffs across our trading partners are remaking the global trading system. Tighter immigration policy has led to an abrupt slowdown in labor force growth. Over the longer run, changes in tax, spending, and regulatory policies may also have important implications for economic growth and productivity. There is significant uncertainty about where all of these policies will eventually settle and what their lasting effects on the economy will be. Changes in trade and immigration policies are affecting both demand and supply. In this environment, distinguishing cyclical developments from trend or structural developments is difficult. This distinction is critical because monetary policy can work to stabilize cyclical fluctuations, but can do little to alter structural changes. The labor market is a case in point. The July employment report, released earlier this month, showed that payroll job growth slowed to an average pace of only 35,000 per month over the past 3 months, down from 168,000 per month during 2024. This slowdown is much larger than assessed just a month ago, as the earlier figures for May and June were revised down substantially. But it does not appear that the slowdown in job growth has opened up a large margin of slack in the labor market, an outcome we want to avoid. The unemployment rate, while edging up in July, stands at a historically low level of 4.2% and has been broadly stable over the past year. Other indicators of labor market conditions are also little changed or have softened only modestly, including quits, layoffs, the ratio of vacancies to unemployment, and nominal wage growth. Labor supply has softened in line with demand, sharply lowering the break-even rate of job creation needed to hold the unemployment rate constant. Indeed, labor force growth has slowed considerably this year with the sharp fall-off in immigration, and the labor force participation rate has edged down in recent months. Overall, while the labor market appears to be in balance, it is a curious kind of balance that results from a marked slowing in both the supply of and demand for workers. This unusual situation suggests that downside risks to employment are rising. And if those risks materialize, they can do so quickly in the form of sharply higher layoffs and rising unemployment. At the same time, GDP growth has slowed notably in the first half of this year to a pace of 1.2%, roughly half the 2.5% pace in 2024. The decline in growth has largely reflected a slowdown in consumer spending. As with the labor market, some of the slowing in GDP likely reflects slower growth of supply or potential output. Turning to inflation, higher tariffs have begun to push up prices in some categories of goods. Estimates based on the latest available data indicate that total PCE prices rose 2.6% over the 12 months ending in July. Excluding the volatile food and energy categories, core PCE prices rose 2.9%, above their level of a year ago. Within core, prices of goods increased 1.1% over the past 12 months, a notable shift from the modest decline seen over the course of 2024. In contrast, housing services inflation remains on a downward trend, and non-housing services inflation is still running at a level a bit above what has been historically consistent with a 2% inflation. The effects of tariffs on consumer prices are now clearly visible. We expect those effects to accumulate over coming months with high uncertainty about both timing and amounts. The question that matters for monetary policy is whether these price increases are likely to materially raise the risk of an ongoing inflation problem. A reasonable base case is that the effects will be relatively short-lived, a one-time shift in the price level. Of course, one time does not mean all at once. It will continue to take time for tariff increases to work their way through supply chains and distribution networks. Moreover, tariff rates continue to evolve, potentially prolonging the adjustment process. It's also possible, however, that the upward pressure on prices from tariffs could spur a more lasting inflation dynamic, and that is a risk to be assessed and managed. One possibility is that workers who see their real incomes decline because of higher prices demand and get higher wages from employers, setting off adverse wage price dynamics. Given that the labor market is not particularly tight and faces increasing downside risks, that outcome does not seem likely. Another possibility is that inflation expectations could move up, dragging actual inflation with them. Inflation has been above our target for more than 4 years and remains a prominent concern for households and businesses. Measures of longer-term inflation expectations, however, as reflected in market and survey-based measures, appear to remain well anchored and consistent with our longer-run inflation objective of 2%. Of course, we cannot take the stability of inflation expectations for granted. Come what may, we will not allow a one-time increase in the price level to become an ongoing inflation problem. So, putting the pieces together, what are the implications for monetary policy? In the near term, risks to inflation are tilted to the upside, and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. Our policy rate is now 100 basis points closer to neutral than it was a year ago, and the stability of the unemployment rate and other labor market measures allows us to proceed carefully as we consider changes to our policy stance. Nonetheless, with policy in restrictive territory, the baseline outlook and the shifting balance of risks may warrant adjusting our policy stance. Monetary policy is not on a preset course. FOMC members will make these decisions based solely on their assessment of the data and its implications for the economic outlook and the balance of risks. We will never deviate from that approach. So, turning then to my second topic. Our monetary policy framework is built on the unchanging foundation of our mandate from Congress to foster maximum employment and stable prices for the American people. We remain fully committed to fulfilling our statutory mandate, and the revisions to our framework will support that mission across a broad range of economic conditions. Our revised statement on longer-run goals and monetary policy strategy, which we refer to as our consensus statement to save time, describes how we pursue our dual mandate goals. It is designed to give the public a clear sense of how we think about monetary policy, and that understanding is important both for transparency and accountability, and for making monetary policy more effective. The changes we made in this review are a natural progression grounded in our ever-evolving understanding of our economy. We continue to build upon the initial consensus statement adopted in 2012 under Chairman Ben Bernanke's leadership. Today's revised statement is the outcome of the second public review of our framework, which we conduct at 5-year intervals. This year's review included 3 elements: Fed Listens events at reserve banks around the country, a flagship research conference, and policymaker discussions and deliberations supported by staff analysis at a series of FOMC meetings. In approaching this year's review, a key objective has been to make sure that our framework is suitable across a broad range of economic conditions. At the same time, the framework needs to evolve with changes in the structure of the economy and our understanding of those changes. The Great Depression presented different challenges from those of the Great Inflation and the Great Moderation, which in turn are different from the ones we face today. At the time of the last review, we were living in a new normal, characterized by the proximity of interest rates to the effective lower bound, or ELB, along with low growth, low inflation, and a very flat Phillips curve, meaning that inflation was not very responsive to slack in the economy. To me, a statistic that captures that era is that our policy rate was stuck at the ELB for 7 long years following the onset of the global financial crisis in late 2008. Many here will recall the sluggish growth and painfully slow recovery of that era. It appeared highly likely that if the economy experienced even a mild downturn, our policy rate would be back at the ELB very quickly, probably for another extended period. Inflation and inflation expectations could then decline in a weak economy, raising real interest rates as nominal rates were pinned near zero. Higher real rates would further weigh on job growth and reinforce the downward pressure on inflation and inflation expectations, triggering an adverse dynamic. The economic conditions that brought the policy rate to the ELB and drove the 2020 framework changes were thought to be rooted in slow-moving global factors that would persist for an extended period. And they might well have done so, if not for the pandemic. The 2020 consensus statement included several features that addressed the ELB-related risks that had become increasingly prominent over the preceding 2 decades. We emphasized the importance of anchored inflation, longer-term inflation expectations to support both our price stability and maximum employment goals. Drawing on an extensive literature on strategies to mitigate risks associated with the ELB, we adopted flexible average inflation targeting, a make-up strategy to ensure that inflation expectations would remain well anchored, even with the ELB constraint. In particular, we said that following periods when inflation had been running persistently above 2%, appropriate monetary policy would likely aim to achieve inflation moderately above 2% for some time. In the event, rather than low inflation in the ELB, the post-pandemic reopening brought the highest inflation in 40 years to economies around the world. Like most other central banks and private sector analysts, through year-end 2021, we thought that inflation would subside fairly quickly without a sharp tightening in our policy stance, as this slide will show. When it became clear this was not the case, we responded forcefully, raising our policy rate by 5.25 percentage points over 16 months. That action, combined with the unwinding of pandemic supply disruptions, contributed to inflation moving much closer to our target without the painful rise in unemployment that has accompanied previous efforts to counter high inflation. This year's review considered how economic conditions have evolved over the past 5 years. During this period, we saw that the inflation situation can change rapidly in the face of large shocks. In addition, interest rates are now substantially higher than was the case during the era between the global financial crisis and the pandemic. With inflation above target, our policy rate is restrictive, modestly so in my view. We cannot say for certain where rates will settle out over the longer run, but their neutral rate may now be higher than during the 2010s, reflecting changes in productivity, demographics, fiscal policy, and other factors that affect the balance between saving and investment. During the review, we discussed how the 2020 statement's focus on the ELB may have complicated communications about our response to high inflation. We concluded that the emphasis on an overly specific set of economic conditions may have led to some confusion, and as a result, we made several important changes to the consensus statement to reflect that insight. First, we removed language indicating that the ELB was a defining feature of the economic landscape. Instead, we noted that our monetary policy strategy is designed to promote maximum employment and stable prices across a broad range of economic conditions. The difficulty of operating near the ELB remains a potential concern, but it is not our primary focus. The revised statement reiterates that the committee is prepared to use its full range of tools to achieve its maximum employment and price stability goals, particularly if the federal funds rate is constrained by the ELB. Second, we returned to a framework of flexible inflation targeting and eliminated the makeup strategy. As it turned out, the idea of an intentional moderate inflation overshoot had proved irrelevant. There was nothing intentional or moderate about the inflation that arrived a few months after we announced our 2020 changes to the consensus statement, as I acknowledged publicly in 2021. Well-anchored inflation expectations were critical to our success in bringing down inflation without a sharp increase in unemployment. Anchored expectations promote the return of inflation to target when adverse shocks drive inflation higher and limit the risk of deflation when the economy weakens. Further, they allow monetary policy to support maximum employment in economic downturns without compromising price stability. Our revised statement emphasizes our commitment to act forcefully to ensure that longer-term inflation expectations remain well anchored to the benefit of both sides of our dual mandate. It also notes that price stability is essential for a sound and stable economy and supports the well-being of all Americans. This theme came through loud and clear at our Fed Listens events. The past 5 years have been a painful reminder of the hardship that high inflation imposes, especially on those least able to meet the higher costs of necessities. Third, our 2020 statement said that we would mitigate shortfalls rather than deviations from maximum employment. The use of shortfalls reflected the insight that our real-time assessments of the natural rate of unemployment, and hence of maximum employment, are highly uncertain. The later years of the post-global financial crisis recovery featured employment running for an extended period above mainstream estimates of its sustainable level, along with inflation running persistently below our 2% target. In the absence of inflationary pressures, it might not be necessary to tighten policy based solely on uncertain real-time estimates of the natural rate of unemployment. We still have that view, but our use of the term shortfalls was not always interpreted as intended, raising communications challenges. In particular, the use of shortfalls was not intended as a commitment to permanently forswear preemption or to ignore labor market tightness. Accordingly, we removed shortfalls from our statement. Instead, the revised document now states more precisely that the committee recognizes that employment may run at times above real-time assessments of maximum employment without necessarily creating risks to price stability. Of course, preemptive action would likely be warranted if tightness in the labor market or other factors pose risks to price stability. The revised statement also notes that maximum employment is the highest level of employment that can be achieved on a sustained basis in a context of price stability. This focus on promoting a strong labor market underscores the principle that durably achieving maximum employment fosters broad-based economic opportunities and benefits for all Americans. The feedback we received at Fed Listens events reinforced the value of a strong labor market for American households, employers, and communities. Fourth, consistent with the removal of shortfalls, we made changes to clarify our approach in periods where our employment and inflation objectives are not complementary. In those circumstances, we will follow a balanced approach in promoting them. The revised statement now more closely aligns with the original 2012 language. We take into account the extent of departures from our goals and the potentially different time horizons over which each is projected to return to a level consistent with our dual mandate. These principles guide our policy decisions today, as they did in the 2022 to 24 period, when the departure from our 2% inflation target was the overriding concern. In addition to these changes, there is a great deal of continuity with past statements. The document continues to explain how we interpret the mandate Congress has given us and describes the policy framework that we believe will best promote maximum employment and price stability. We continue to believe that monetary policy must be forward-looking and consider the lags in its effects on the economy. For this reason, our policy actions depend on the economic outlook and the balance of risks to that outlook. We continue to believe that setting a numerical goal for employment is unwise because the maximum level of employment is not directly measurable and changes over time for reasons unrelated to monetary policy. We also continue to view a longer-run inflation rate of 2% as most consistent with our dual mandate goals. We believe that our commitment to this target is a key factor, helping keep longer-term inflation expectations well anchored. Experience has shown that 2% inflation is low enough to ensure that inflation is not a concern in household and business decision-making, while also providing a central bank with some policy flexibility to provide accommodation during economic downturns. Finally, the revised consensus statement retained our commitment to conduct a public review roughly every 5 years. There's nothing magic about the 5-year pace. That frequency allows policymakers to reassess structural features of the economy and to engage with the public, practitioners, and academics on the performance of our framework. It is also consistent with several global peers. To wrap up, I want to thank President Schmid and all of his great Kansas City staff who work so diligently to host this outstanding event annually, counting a couple of virtual appearances during the pandemic. This is the 8th time I've had the honor to speak from this podium. Each year, this symposium offers the opportunity for Fed leaders to hear ideas from leading economic thinkers and focus on the challenges we face. The Kansas City Fed was very wise to lure Chair Volcker here to this national park more than 40 years ago, and I am so proud to be part of that tradition. Thank you very much.
That was Fed Chair Jerome Powell wrapping up his annual Jackson Hole remarks. What a Jackson Hole speech that was. This is Bloomberg Surveillance on television and radio, live from Jackson Hole, Wyoming. What we heard there is they are prepared to move rates lower on the heels of their dual mandate being in conflict. We see a market reaction. We could see 10-year yields are lower by 10 basis points. 2-year yields are down by 10 basis points. So 10-year yields are down by 7 basis points. What you see is a weaker dollar, stronger euro by some 0.7%, which you can see the dollar just weakening across the board, and you can see that increase on the equity space. We have been getting some other news. President Trump has been tweeting saying that if Lisa Cook, Fed governor, doesn't resign, he will fire her. There also was some drama in the main hall of the
What's up, fam? What's up, and welcome. We just watched Jerome Powell speak, and the reason why you saw the price completely changed for XRP, for Bitcoin, for Kronos, for Ethereum. 8%, 7%, 2%, 3%, 5%. What a beauty that was. Why? Because he is now signaling a change, and that is a cut, and that is the reason why we mentioned very much many times, guys, to you, fam, that do not look at the dips as, oh, it's over. Take a look at them as opportunities. And I told you yesterday and many days ago, guys, you see how fast things change? That is all the institutions that were waiting on the sidelines, just waiting for this guy to open his mouth and say, cuts, cuts. And he now is doing it. He is saying, okay, you know what? It's time to change. It's time to do something different. And boom, just today, right now, over $3. Now, don't pay attention to what the price is, to 99, to 98, to what, guys, things are about to change. And that's so good. So answer to this was dovish, absolutely dovish, everybody, which is nice. We're going to go ahead and listen a little bit to, because to be honest with you guys, I was just looking at the price at some point. So let's go ahead and start, because I thought that he wasn't going to go live, but then they went live with him, which is good. So I just want to have the first few minutes of the conversation. So, because that's where you see, oh, that's when the price started to go up and up and up and up and up. So take a look at this.
Expectations and downside risks to employment. The Fed chairman says the inflation outlook is that it will rise, but
so there it is. The reason why it changed is because the balance of risk may warrant adjusting our policy stance. They're not going to say we're going to cut. They're not going to say, hey, fam, we're cutting. No, they're going to say we're going to adjust. But the whole market knows, okay, you mean cutting.
Perhaps at a slower pace. So right now we are looking at a Fed that has the door open for a September 17th cut. And I guess...
You see that? You see that? You hear that? We see and we hear a chair open to a September 17 cut. So if you ask me, Oscar, why are we pumping? There's your answer. There's your answer. You came here. We got over 5,000 people at some point. So welcome, guys. Links down below. Join us on BTCC. We got 2,000 XRP for one giveaway to one trader, and we have 1,000 USDT for, just coming from Oscar Ramos, guys. Links down below, BTCC. You can use it in the US, many parts of the world. Join us. This is the time for you to get in, guys, okay? This is so good. This is so good. Now, Trump is speaking right now. I'm trying to find it, but I mean, I don't know. It's not on there on X. Trump is speaking like at the DC Washington Museum or so. I'm trying to find it, but if I find it, I'll go to him right now. But I don't know. Fox, do you have it? Okay, there's still, what is this? Chairman vote for long-term Trump rally? No. So Fox is showing something else. But anyway, he's speaking. It's just maybe some other conversation about DC to make it safe. But what I'm saying about this, guys, is this is what we wanted to hear. This is what we wanted to hear. We were on the fence as like, is he going to cut? Is he not going to cut? Is he going to cut? Now he is confirming that there's going to probably be a nice change, and this is so good.
Yes, Lisa, we're probably going to see the long end and the short end reacting here.
Well, let's pull that up right now. You do see an absolute catering in yields on the heels of this opening up to the potential for rate cuts coming out. The downside risks to employment are rising. What you can see also rising, the S&P 500 now up 1.3%. Yields down 8 basis points on the long end for the 10-year, even more for the 2-year.
And looking at the inflation-adjusted yield, the 10-year real yield comes in 6 basis points. That is substantial. It's still within the range, but at 1.86%, it's a real reversal towards a presumption of Fed accommodation.
Yeah, and this comes at a time where there is this question of how they are going to message this, given that inflation has remained above that 2% target since 2021. Mike, do we hear anything about why this is a Fed willing to look through that kind of inflation?
They do anticipate that tariffs are going to add to inflation, and they think it will take place over time, but they're still looking, at least as Chairman Powell puts it, they're still looking at these as one-time price adjustments within each sector. So it's likely that inflation is going to go up, but then they think it stabilizes and might go down.
Nice. What is this? Crow?
Dollar XRP. Bought the dip again. Thanks, Oscar.
What's up, Kenny? And thank you so much to all my donors and all my people and the new subscribers and new members, guys. Welcome to all my awesome moderators as well. Thank you so much for being here, guys. And I will say a pretty important day to go live and to listen and to see, what's happening in the world. This is exactly why we buy the blood on the streets, fam. I'm so excited for September now. I'm really, really excited for September. And if we have a chance to get another dip, if we have a chance to see some blood on the streets, go in because things are going to move. Plus, we have Clarity Act. We have Clarity Act coming in, the market structure bill. I made 2 videos for you guys. Market structure bill. So we watch the 30-minute conversation with Stewart, right? Remember that one? Some of you watched it. I know it was long. But it's just so good to hear this, guys. That's so nice.
Again.
Well, right now, let's take a listen to Jay Powell, chair of the Federal Reserve.
In my remarks today, I will first address the current economic situation and the near-term outlook for monetary policy. I will then turn to the results of our second public review of our monetary policy framework.
So while he was doing all of that, like he gave that, as soon as he just gave that, it might be already on X. It might be already on X. Let's take a look at that one, fam. Let's take a look at that one. Let's see. Give it a look to X. Man, that's a good. I'm so happy, man. That this is what I wanted to hear. Okay, summary. Jesse, what do we have for us? Summary. Powell citing job risk open the door to a September rate cut. That is the big one. September rate cut. Powell says risk to employment is rising. Powell says base case is tariff impact on inflation will be short-lived. And Powell says base case balance of risk may warrant policy adjustment. Meaning, what took you so long? What took you so long? That's what a lot of people are going to tell them right now. In the famous words of Donald J. Trump, too late, Jerome Powell. It happens, but I think a lot of people got the dip. A lot of people did want to see blood on the streets, and some people are saying playing politics. CME 91? No way. Let me take a look at CME. Let's take a look at CME. 91? No way. Let's go, baby. That's exactly what I wanted to see. I'm going to take a look at Poly Market right now. Man, I love that. I love that. Don't be mad at Chair Powell. He's just trying to live up to his nickname. Oh, man. Guys, there's going to be a September rate cut. To those who bought before this, well done. Well done. To those who bought right now, well done too. You have about 6 weeks. You have about 6 weeks. No, what 6 weeks? You have about 3 weeks or so in between, right? We have to wait a little bit for September, middle of September. And actually, I think it's going to be great, right? Where we're going to head, where we're going to go before that cut actually takes place. I'm so happy for that. This is good for us. This is good for crypto. This is good for the markets, and everybody's of course pitching in and saying, okay, so what's happening, man? I'm gonna show you how right here I saw one headline. I like it. This one.
Broad range of economic conditions.
Stocks,
At the
bonds,
same time,
stocks, bonds jump as Powell signals Fed will cut. That's it. Now we know Fed will cut. Are you seeing it right now? Like for reals? Ethereum just went up 10%. 10%. The second largest crypto in the world just went up by 10%. I like this, you know? I really like this, guys. Dude, that's so good. How about Kronos? My Crow fam, we did phenomenal. Binance did so good. Caspa did so good too. Solana coming back to the 200 soon. Stellar, also really good. Stellar. What's up, Lee?
Under
The
$1
$1
club,
buck.
haha, good times, love your work, and shout out to chat to good value XD.
Thank you so much, Lee. Appreciate it. And welcome, but welcome. Dangerous Dave in the house. Love it. Pumping music. Oh, you guys want some pumping music? I get it, fam. And XRP. Man, that's so good. We're going to get some pretty nice positions. Those who were adding before everything came in. Okay, I believe Trump already stopped talking. So Trump is going to be speaking right now in about an hour and a half. 1 hour and a half. He's going to come in from the Oval Office and chat and, have a good time with us. See what he has to say for us. Watch a Guru. I'm going to Watch a Guru right now, seeing what's going on. But I think we deserve it. I think we deserve a little bit of craziness. Why not, fam? This is exactly why I love crypto, because we don't sell based on our emotions, right? We take profits once the FOMO comes in, and that is how you make the most money in crypto. Drop a like, fam. Consider subscribing to the channel. Turn on those notification bells. Don't go anywhere. Welcome to the chat. Welcome to the fam. It's a good day. It's a good day. Things are about to change. Things are about to change. Bitunix is not working. Is it not working? Let me take a look. Let's see. I see abnormal system. Yeah, it's not working. For me, it's not. You guys not working too? That's bad. That's not good. You gotta fix it. You gotta fix it fast. You gotta fix it. What's up, desk? Welcome. I'm broke Bitunix. Man, that's so good. Ooh. Now it's working. I'm gonna take like 10 seconds right now to reset my mind right now. Ooh. Thank you, Oscar. Well done, everybody. Weak bump. Elevator crypto music. First time here. Already making gains. I love to hear that, buddy. I love to hear that. I still hold Pengu. Of course I hold Pengu. Of course I hold Pengu. Okay. All right. So you stay in until Trump speaks. I just want to finish with a few things and then I'll come back. But for everybody here, a few things I want to mention. Number one, from right now, August 22nd to till middle of September, we'll have a lot of problems and issues in the world, and we may have another meeting with Vladimir Putin, right? I mean, we'll have geopolitics playing, come into play. But I think as far as the market, and I think now with this, there's not really a big reason to drop other than war or something happens, God forbid, to Trump or whatever. Other than that, I think we're going to be fine because the Senate is passing many crypto laws, regulation, and I think all of that helps really well. So I've been doing it, and I know you've been doing it, guys. I've been doing it with Algorand. As you know, we did really well with XRP, with Ethereum, with Cardano. My backs right now with I'm adding Algorand. I really like it, and I'm doing well. I bought yesterday, bought today, so I'm really happy. So I'll finish up with my Algorand bag, and I'll move on to other ones. But remember that I told you guys, right? Under $3 XRP is the level to buy. Under $3 XRP, it's so good that we're back to 3 because that brings us to a nice level of consolidation that is gonna help us go to the next level. So good stuff. The other thing I wanted to take mention and to let you know before things get much crazier. Some of you know my 2000 XRP giveaway with BTCC, guys. I really highly recommend. I told you yesterday. I told you the day before. And for those people who open up their account with my link, right? This is only if you are one of my referrals. If you open longs, no matter if it's Bitcoin, XRP, or whatever, as long as you are opening longs in your BTCC account or shorts, whatever, you're making money, right? You are getting closer and closer to that 2000 XRP giveaway, right? So kudos to you guys. Make that money. Sign up right now. The links are down there or top of the chat. I want you to win. I want you to get closer to that promised goal. But that's not all. That's not all, guys. That's not all. BTCC told me, you know what? We really like you guys. Make more money. And I'm like, what? We also have another giveaway, which starts from the 20th to the 27th. So you still have 5 days, 4 winners, 250 USDT per winner. So that's another one, guys. There's so many things BTCC is doing for my community, and I'm so thankful. So another reason to get in on BTCC right now and try it out. And if that wasn't all, like if you're like, come on, man, give me more money. Well, we have the up to 10,000 welcome bonus and for everybody joining, right? So I think there's all things for you guys to give it a try and make money and get excited. And this is why we're here. Good? Whew. This is so good. The prices continue at 3. I like it. I'm going to take a look at Watch Your Group for a second. Bitcoin 116,000, Ethereum 4,600, which is Bitcoin. It's actually going up too. It's going up too right now. Yep. In the 1 hour, look at that. That's exactly what Bitcoin is. It's so good right now. So good. It's so good. Oh, the Gemini billboard. I know, right? Gemini, XRP. Yep. Look at that. I haven't mentioned this in any of my videos yet because I've been busy, but yeah. Prepare your bags. Prepare your bags. If you prepare your bags before this announcement today, well done. If you prepared your bags before the announcement today, well done. Okay? Here it is. So these are the news of today. These are the news of today. So good, guys. So good. One thing, too, I'm so happy to be partnered with great people that support XRP. I'm so happy to be partnered with people and companies that are all crazy about XRP. And that is why I want to make a mention to my partner in crime, Epic. Yesterday, I told you about it, and I want to keep telling you about it, guys. And I'm going to take a look at how it's doing. And I think those who got in, very good. Oh, wow. Nice. Oh, last 7 days, 44%. That's so good. Shout out to Epic Chain, a company that is backed by Ripple. Shout out to them because it's the world's fastest growing RWA ecosystem backed by Ripple. You've heard them from different content creators, and I'm partnered with them. And I want to say that, so far the team has been pretty spectacular. They're all, of course, doing so many things that are helping just crypto users as a whole and just bringing real world assets, right? With technology and with things that are going to help a lot. Plus, they're now live with Uphold. Fiat access expanded across the US, EU, and beyond. So Uphold is the leading XRP gateway with 8.5 billion managed XRP on the token consistently. So there's all these custodians that are saying, give me your XRP, we'll take care of you, and we'll give you maybe some yield. That is Uphold. To be honest with you guys, I prefer to keep my XRP, in my wallets. But I know a lot of people have Uphold, and I know a lot of people have their positions with them. Totally fine, not a problem. Do whatever you want with your XRP. But I do prefer have it on me at all times, right? So it's good. Coins PH saying token listing, Epic too. So it's growing. It's growing this community, and I think it's expanding into levels that I like to see, right? So we of course want to see good projects win, right? Not like the Kanye West meme coin that we saw 2 days ago or so. That's just insane. A big shout out to the world's fastest growing RWA ecosystem. Epic is building the world's first RWA superstructure, aligning institutions and consumers across every major asset class. Someone says, Uphold is horrible. I don't use it, but I don't have anything against with them. It's just that if I'm holding my coins, I'll give you my opinion about it, right? Just so you know. If I buy Cardano, I'm going to put it in the Cardano wallet. If I buy Algorand, I want to put it in the Para wallet, in the Algorand wallet. If I buy XRP, there's really no an XRP wallet. There's no like an official XRP wallet. So a lot of custodians are telling me, hey, come here, give it to me. No, I'm putting it in a good trust wallet, ledger, whatever wallet that you obviously is decentralized. And I'm the one responsible, right, to keep it. That's what I do because you never know, right? Do not leave money on exchanges, right? And today I wake up and you guys are telling me here in the comments, what's going on, Bitunix? Now, I'm going to have to DM some people about Bitunix today because obviously I have my links and I used Bitunix. They told me that it's not available for the US. I think it's for people that are outside of the United States, right? So they just told me that. And I'm like, okay. So if you guys keep looking, I'm sure I'm going to go on X and see what's going on right there. But yeah, for sure we need to have access and see what's happening. So it comes to show that having your assets an XRP where you can control it's the most important and rule number one. Period. See? I use Uphold to buy, Tangent Wallet to store. Well done, Bad Warrior. Well done. Well done. Because remember, like Robinhood or PayPal or Cash App, you're going to buy Bitcoin, but they're going to charge you a fee. That fee is to make your life easier, right? So, FYI. So, guys, shout out to Epic. And I just wanted to make sure that you are aware. And there's more to come for them. And I want to keep you in the know. Different asset classes. All right, fam. So that's all I got for you right now. We're going to keep watching. And I'll be back for Trump. I'm going to take a little break. I'll see you soon, guys. Peace.